Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. As always, we're streaming on expertcresecrets.com and the Capital Gains Tax Solutions YouTube channel, so make sure to hit that thumbs up button and that subscribe button for us. It really helps out the channel. Thank you so much. I'm super excited about our next guest, where this gentleman has been in real estate for the last 17 years in recession-resistant assets, including multifamily, storage, mobile home parks. He's a wealth of knowledge. We're going to get a great value add from him today. So please welcome Mark Carey. Mark, how you doing, man?
Good, Pearson. Doing well. Thank you.
Awesome, Mark. So tell us your story. How'd you get to where you are?
Yeah, keep it short, Pearson, but started out as a financial analyst in corporate America for a number of years, doing budgets, planning, a lot of spreadsheets, some internal auditing. And then I moved over to a small company, was doing operations management, helped that company expand from about $5 million in revenue to up to about $95 million in revenue. And then the recession hit them hard, back down to about $3-4 million in revenue a couple of years later. So bit of a ride there that we took, but along the way, I was investing in real estate on the side, predominantly with myself, some family members, partnering, putting capital together, buying some attractive deals through the recession, and decided to, really shift into that. 2010, full time, started our company, SMK Capital Management. Today, we focus on the private equity side of, institutional quality commercial real estate. We raise capital from our investor group. We partner with operators and sponsors that we have relationships with, and typically focusing today on a few of the assets you noted: apartments, mobile home parks, self-storage, a few other niche asset classes as well.
Awesome. So, Mark, I believe everyone's been given a set of gifts or strengths, superpowers, whatever you want to call them. What are one or two that have led you to be successful today?
Okay, yeah. I'm very detail-oriented, Pearson. It's just something that I found throughout school when I was young. I can absorb a lot of information, and I think that's a gift. It's also potentially a little bit of a skill that you work on, but I like to analyze and look at a lot of data. I think that's pretty helpful when we're looking at investments. It's helpful when analyzing operating partners and sponsors to work with, and it's also helpful for our investors kind of at the end of that line as well.
So extremely detail-oriented in your ability to retain information and then apply it across different things. Well, not skipping out on the details, huh? That's important. A lot of people catch the big picture, but they can't get into the nitty-gritty. So the fact that you can, do the details is really important. Awesome. Okay, cool. So let's get into this. What's the number one secret to recession-resistant assets?
Number one, maybe I'll give you a couple thoughts here. So what does it mean to be recession-resistant? Number one, I'll start with that. To us, looking back at the last several years, in 2018, we kind of thought at that time there was a lot of indicators in the marketplace that there could be a market correction coming soon. And we wanted to best position capital for a downturn, for a recession. And so we went out and created a fund that invested in mobile home parks, self-storage, and Class B workforce housing in growth markets. Put that together, closed the fund to new capital in 2019. The purpose of that, Pearson, was to weather a storm, right? Keep doing well as far as cash flowing, providing investor distributions, and retaining asset value. And so we've done that quite well. We obviously have seen some bumps along the way since we closed that fund in 2020, COVID. We stopped investing entirely for 7 months, just analyzing the markets, trying to determine, is there going to be distress? Is there going to be, tenants' inability to stay and pay, occupancy dropping, et cetera, supply increasing? We didn't see that. We kind of saw the opposite. A lot of demand, high demand from residents, users of the assets, and then also from other equity groups who we're selling to, right? So you want to always look at your exit strategy. And we found that the number of buyers for these assets was increasing pretty quickly. By about Q3 2020, we decided to continue what we were doing as far as investment strategy and thesis, but we added kind of shorter term deals, Pearson, to our criteria, 2 to 3 year holds. We didn't do that prior to COVID. That's the one main shift that we adjusted after seeing a lot of the tailwinds that were created through the 2020 or so. Rapid rent growth, rapid cap rate compression. And so we, prior to that, we were really only focusing on 5 to 10 year holds. Again, really trying to weather a storm. Fast forward to Q1 of 2022, we stopped and paused all shorter term deals again, moved back towards recession resistance, very much focusing on long-term fixed rate debt, conservative loan to cost, yield on cost, looking at a lot of these metrics, stabilized assets that have a value add play, and really more 5 to 10 year holds again. So that's a bit of our evolution over the last several years and how we focus a bit more on recession resistance.
Yeah. So something I want to bring up, you wrote a book, Navigating Passive Real Estate Investments in a Post-COVID Era. And you kind of mentioned how you shifted during the pandemic, right? From a long-term, buy and hold, value add, stabilized assets to a really quick, almost like a flip in some, sense. And then kind of move back to a longer term. So this is going to sound dumb, maybe, but like, and you guys can all get a copy of the book by going to smkcap.com/5 steps, all one word, number 5 steps. You guys can grab a free copy of that book. So I highly recommend going out and grabbing that. How is what you just described in the book?
Yeah, and just to clarify, guys, it's an ebook, right? So it's ebook. 5 steps. Yeah, it's not a publicated normal large book, but what we do is we go through in this ebook and we explain kind of our thesis in a quick review, right? And how we execute on recession resistance, Pearson. So people, number one, working with the right people. And that's been part of our success over 12, 13 years now. We've aligned ourselves with some of the best in the industry. And we pay very much attention to people. Diversification, it's a big part of our business, has been since day one. So we continue to diversify, and we diversify a few ways, Pearson. We already talked a little bit about duration, investment duration, short-term, medium, long-term, asset classes, operating partners, location, all of the above. A few other things we mentioned in there. I won't mention it all today in lieu of time, but deal analysis and underwriting, how to spot maybe overly zealous, rosy projections in assumptions and pro forma models. And really the goal of that is you want to walk away from looking at a deal and be able to feel very confident that you can meet or beat the projected returns. And we oftentimes see a lot of deals that we don't say that when we're done reviewing them. We say, gosh, all the stars would have to align to be able to get to the projected return. And so that's a big part of underwriting and analysis, is really reviewing the assumptions and feeling a lot of conviction and looking for conservative assumptions in deals. There's a couple other points we mentioned in there. Understanding the need for capital, right? We focus on partnering with operating partners that are specialists in one thing. We do that across multiple asset classes. That's one of the ways we create diversification. And understanding our operating partners' need for capital. Do they need capital? Why? How much? Where are they in their business history? Are they young? Are they old? Et cetera, et cetera. And really trying to make sure there's a win-win there. In the last several years, I'm sure you guys know this and seen it, but there's been a lot of companies that have grown very quickly. And you want to be able to assess, why is it that they're growing so quickly? Are they really good at operating? Or are they really good at marketing? Or maybe both. And so trying to figure that out, really align yourself with what we look for is just really great operators and really understanding the need for capital. So those are some of the steps that we mentioned in the ebook.
Awesome. Awesome. Okay. So you mentioned something that I want to kind of just park on for a second, really quickly. And it's, when you guys are developing these relationships with these operators, you mentioned people first. I've probably the most important thing that you can have. You could have a poor plan, but if you can execute it, like, it's better than a great plan you can't execute.
Yeah.
So how do you vet operators?
Sure. Almost always, Pearson, either we've personally invested with them, myself, my family, and we have a little bit of experience there, or one of our investors has invested with them and they have experience. And so experience is number one,
Okay.
to being able to, kind of get your foot in the door with the right people. If you can have that referral or your own personal experience, that's a great step. From there, it's a process, and sometimes it can be a couple months to vet and understand an operating partner, and sometimes it takes years. And it's always ongoing, meaning if we vet an operator, we really like them, there's a great fit here, we invest with them, it doesn't stop, right? At that point, now you have a live deal with them. So how do they communicate? How are they doing? How's the performance versus pro forma versus budget, et cetera? Constantly tracking, monitoring, speaking with them, looking at financials, and really understanding, are they steering the ship the way we thought, better, worse, why? Something changes in the marketplace, supply, demand, whatever it may be, are they able to pivot and adjust and continue to stay the course properly? And these are some of the things that we always watch for when we're investing with folks. It's an ongoing process. Right now, today, Pearson, we have I think we've vetted about 125 operating partners over the years, and we currently have 3 buckets that internally we look at: yes, no, and maybe. The yes bucket is about 15 groups, maybe is about 65, and the remainder is in the no bucket. And so that's an internal snapshot of kind of how we do it.
Yeah.
But again, you're dealing with people, you're dealing with companies. Companies evolve, they change, they grow, and you need to be able to understand, how they're doing and how they're most likely going to continue to do as well.
Yeah, absolutely. You also mentioned that when you flipped your strategy from a buy and, hold for longer term to shorter term, you guys were selling assets, right? So how are you dealing with the capital gains tax and the 1031? And what has been your biggest frustration within a 1031?
Sure. Yeah. So we're typically creating securities, so it's a little more difficult to implement a 1031. And so most of the time, if our operating partners and we're in a deal and there is an exit, they will try and source a like-kind property, of course, and be able to have conviction around it without just being rushed into something that we don't think is worth it. That's become harder and harder as of the last couple of years. We've tried, to be honest with you, Pearson, to find great deals on an exit, but most of the time we find them to have higher risk and lower return, and may not be worthwhile from an investment standpoint to really transfer into that asset. And lately, we've actually chosen to pay the capital gains, and so that might be where you and I can talk more down the road.
Yeah, interesting. I mean, the first thing is I want to just kind of pat you guys on the back for making wise investment decisions without letting the tax be the thing that kind of forces you guys into a deal. You can get caught in a bad deal just because you don't want to pay the 1031, the capital gains tax, and you're trying to force your 1031, and it's just so good for you guys for not, for taking the hit, but not, making unwise business decisions because of that. So that's the first thing. The second thing is that, with the 1031, I talked to a lot of syndicators. I talked to a lot of operators. I talked to a lot of people. And I ask this question pretty much every time, and it's the same answers, that just rotate around, right? It's time constraints. It's like-kind constraints. It's if you're a syndicator, you leave, millions of 1031 dollars on the table because it's a ton of paperwork. And if it's not high enough, right, it's just not worth the squeeze. You got to move together. You got to find the right property. It's hard to find an up leg. Deals are, scarce, all this stuff, right? It's the same things going on and on. So, and that's really why this podcast exists, and what we're trying to do is kind of share, hey, we have alternatives to that 1031, where you can build, a capital gains tax exit plan without having a 1031. And 1031s are great. Don't get me wrong. Like when there's a deal, like, and there's an up leg, like they work great. Well, we're all for it. Like, hey, yeah, sweet. But for those, deals that you talk about where you're like, we don't know what to do, we just kind of pay our tax and move on. We use a different strategy. It's called the Deferred Sales Trust. I'm curious, have you used a Deferred Sales Trust? Have you heard about it? Have you, what has your experience been with it?
We've heard about it, but we haven't used them.
Yeah. That's kind of, they're up and coming, like, for, people. And I think, Brett's done a really great job in capital gains tax solutions and marketing it and getting the word out there. It was a protected for a long time, for the last 20 something years, and walking this line of, hey, we need to prove efficacy. We want to make sure we, really forge a great, process and outline and make sure that it's tested through the IRS. And so now there's thousands of closes, billions under management, 26-year track record, over 20 audits and reviews, all of them, no changes, no findings, formal audits from the IRS. So we've created now our path, our efficacy, without, pioneered it essentially without having the arrows shot in the back, right? So, that's something that's really important to be asking yourself. So, the Deferred Sales Trust is an awesome strategy. It's like-kind agnostic. You can liquidate assets, not just investment real estate, but you could also do a business or a primary home or crypto or stock. We're working on a deal right now with a highly appreciated racehorse. So it's crazy what you can and can't do with some things and what you can do with others. So, and what's unique is there's no time constraints. It's like-kind agnostic. So you could sell a racehorse and go into stocks and businesses and real estate. You could sell, a real estate and put money into SMK Capital's funds. You could, sell crypto and do a combination of SMK Capital's funds and, your own real estate deal and some businesses and some stock. So there's so many different options. There's so much flexibility around it. So it's a fantastic tool. I encourage everyone to go out and learn more about it. You can find out more about it by going to capitalgainstaxsolutions.com to start that, and obviously listening to this podcast. And then we have a mastermind every Friday at 10 a.m. Pacific, 1 p.m. Eastern, for those of you who want to come and learn more about it. Ask your questions, bring your CPAs and all that kind of stuff. So that's a little bit about the Deferred Sales Trust and what we kind of do and what we're kind of here for. So Mark, before we're kind of coming up on time here, but before I let you go, I wanted to just kind of quickly touch base on a couple other things that you had talked about. And that is, you guys do conservative underwriting, right now. So when a deal comes to you, do you guys feel that, and the underwriting is not conservative, are you out on that deal immediately, or do you just conservatively underwrite the property yourself and then turn around and make an offer based on that? Or how do you guys handle that situation?
Yeah, it depends how aggressive the underwriting assumptions are, Pearson. So yes, there's definitely deals where we'll just 5 minutes, we delete it. It's not going to work for us.
Gotcha.
At the same time, there's sometimes, we run sensitivity analysis and we'll look at exit cap rate assumptions, rent growth assumptions, occupancy, bad debt, single line item expense assumptions, et cetera, and stress them a little bit. And so if it's close and we're working with our operating partner, sometimes we'll adjust the pro forma together and we'll say, listen, we're going to tweak these assumptions because we think they're just a little bit maybe too high, and we'll lower them. And then the deal may still work for us. And so it can be a hands-on or it could be a no. Either way, it just depends on the deal. But yeah, we look at it very closely and make sure that it makes sense for us.
Yeah, interesting. How are you guys, I know you kind of switched to a longer term strategy, right, and diversified and whatnot. How are you handling what's going on in the economy today?
Yeah, I mean, it's all part of what we do every day, Pearson. We're constantly looking at the capital markets, which is the biggest kind of hurdle in today's transactional environment. And we're trying to understand, what are we going to do? Are we going to just sit out, which we're fine doing and waiting? Are we able to source and identify very unique structures and deals where they're essentially resistant to what's going on in the capital markets? And so we have been able to do the latter as of lately. We focus a lot on affordable housing. We believe in the long-term demand for that asset class from users and from end buyers. And there's also some structures within that, where we can do, a partnership. It's really public-private partnerships. We're able to allocate up to half of the units for an affordable component on let's say an apartment building in Texas, for example, that's tied to area median income, AMI. And in exchange for that, we get a property tax abatement, right? So it's a very specific niche asset class. And that provides us with much lower expenses, right? You no longer have to pay property taxes on a property in Texas. Property taxes are real high there. On the stabilized apartment community. And you're also providing the local community with affordable housing. In exchange for that, we restrict 50% of the units as far as the rental rate goes. And we qualify for that property tax exemption. You also get better financing, fixed rate, long-term debt. The last one we invested in, Pearson, we had 10 years fixed, 7 years of interest only, 76% loan to cost. And so very favorable structure, very attractive returns as well, lower expenses, and creating a win-win with affordable housing in the region too.
Yeah, affordable housing seems to be like the play right now as far as like some of those investments are concerned. I'm starting to hear a lot of affordable housing, and I think there's a lot of benefits, like you just mentioned, to it, and that makes a lot of sense. So awesome. Well, Mark, where can people find you?
Yeah, just go to our website, smkcap.com. SMK Capital Management is our company. You can also email me if somebody wants to chat. We talk all the time to our investors directly, one-on-one, very much personal, relationship-based business. My email is, you can email me at info@smkcap.com.
Awesome. And if you guys want to learn more about the capital gains tax deferral solutions that we offer, go to capitalgainstaxsolutions.com. Join us for our mastermind. Mark, any parting words?
I would just say, be careful right now. The investment environment's going through a lot of hurdles. If you're not sure about something, it might be better just to wait. I think we'll know a lot more in the next couple quarters as to where things might go. Fundamentals are very strong still for affordable housing. We believe in the asset class. Occupancy rates are very high. Demand is very high. Rents are still growing at the moment. And so be a little bit cautious, but I also don't think it's time to be sitting out. There's still great deals and great investments out there.
Awesome. Cool. Mark, thank you so much for coming on, man. Really appreciate it. Thank you for all the wisdom and all the insight that you've provided to the listeners over there. I know that they got a ton of value. I did, so I'm assuming they did too. So thank you so much for coming on, man. Really appreciate it.
Yeah.
Thank you, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. Please rate, review, subscribe. Thank you guys so much for listening. And Mark, thanks again for coming on, man. Really appreciate it.
You got it. Thank you.